Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of foreign pensions, Internal Revenue Code Section 401, 402, 501, and employment trusts. To begin, we're talking about privatized pension. This is different than like if somebody has Social Security in a foreign country. Under most tax treaties, Social Security is going to be exempt. So let me give you an example. Let's say Michelle is in country A and she's receiving Social Security from country A. If there was a tax treaty, a double tax agreement, right, with that country, it will normally say something along the lines of only country A has the right to tax Social Security from country A. So even if Michelle is living in the United States, country B, and generally residence or the country of residence is where the tax takes place, if it's public Social Security, the U.S. doesn't have the right to tax it under most treaties. That's limited to the country of source, and that's going to be country A. We're talking about foreign pensions. So foreign pension plans are a little different. The World Bank created a pillar system back in the day. It was 3 pillars, now it's 5 pillars, to kind of help countries with the situation where the population is just getting older. People need to prepare for retirement, right? So U.S. Social Security, for example, is going to fall under Pillar 1. Most foreign pensions are going to fall under Pillar 2 or 3. If you're looking at Social Security in the U.S., it's in a joint fund. You don't get to decide how it's going to be invested. You can't take a lump sum, things like that. With foreign pension, generally there's going to be a separate account identifier. You may only have to contribute if you're in that country or working for an employer. Some of them only require citizens of that country to have to pay into it. If you lose that status, you can get a lump sum of whatever the value is. Your beneficiaries receive a lump sum upon death, permanently disabled, things like that. You can choose the investment strategy. That's kind of how it's different than Social Security. 401 is where you start. If you're qualified under 401, then you generally will receive exempt treatment under 402A. Your 401k, right? A 401k, basically the contributions are not taxed when they go in. The growth is not taxed while it's accruing. Rather, the employee will receive distributions when he or she retires. And when they retire, the goal is for it had grown hopefully significantly, right, during that time period. And now that you're retired, you're going to be at a lower tax rate. So you didn't pay any tax on the growth. You didn't pay any tax on the contributions. You didn't pay any tax on the growth. You pay tax only when you receive it. If it's a foreign pension, it can still qualify under 401. There's a subsection to 402 that basically says, hey, if it's a foreign, if it qualifies otherwise, just because it's foreign doesn't mean it won't qualify per se. But the reality is foreign country pension plans were not designed to meet the U.S. tax code, right? So most of the time they're not going to qualify. Rather, they're going to fall under 402B, which are non-exempt trusts. So forgetting for a minute if there's a treaty, generally it's going to go like this. The contributions are taxed when they go in. Once it's made available or there's distributions, it's going to be taxed. So you don't get that. The contributions are not going to be avoided. You're going to pay tax on that, and then growth can be considered taxable depending on what is the definition for the IRS of what's made available. Obviously, distributions under any scenario are going to be taxed unless otherwise exempt under some other code section. So let's go through a couple of examples, right? You have your Singapore CPF, Central Provident Fund. It's foreign pension, but it has some tenets of Social Security. There's no tax treaty with Singapore, so the IRS issued some memoranda back in 95, 96, basically saying this. But let's compare it to 401k to give you an example. Michelle makes $150,000, right? If Michelle is in Singapore and a Singaporean employer takes $10,000, puts it into the CPF, that $10,000 is taxable when it's earned in the U.S. She might receive tax-deferred treatment in Singapore, but under U.S. Requirement, she's going to pay tax on the full amount of her $150,000 worth of income. If instead $10,000 went into the 401k, well, that $10,000 is not taxed, so she gets to deduct that $10,000. Let's say the Singaporean CPF earns $5,000 of dividends. It hasn't been distributed. Under Singaporean law, she's not going to pay tax on the growth. Under U.S. law, she's going to pay tax on that $5,000 of accrued dividends. If it was in a 401k instead, right, then it's not going to be taxed until it's distributed. So it can be a major tax consequence for when people are considered a U.S. person for tax purposes and also have foreign pension. If there's a treaty, then it depends. Like if you look at the Australia tax treaty, it would appear from reading it that the contributions into the super are going to be taxed, just as that example with the CPF, because there's no section in the treaty with Australia that says, at least currently, that says those contributions are not going to be taxed. To give you an example, under the UK treaty, there's a section, it's 17 or 18, I always forget, that says if you're a US person, you're working in the UK for a UK employer with a UK pension fund born out of employment, as opposed to, let's say, a personal investment fund, well then you can deduct those contributions into the foreign employment pension trust, the same way you would have done for 401k up to the limits of the 401k. So most treaties are not that robust. So most treaties, the contributions are still going to be taxed. Some treaties will say the contributions are not taxed. The growth within, most practitioners take the position that the growth is not taxable. Whether it's made available or not could have some impact. But when you look at the treaties, most of them will say something like the country of residence has the right to tax the distributions of, in the pension. So distribution seems stronger than availability, and therefore it would seem that unless it's being distributed, that it's not going to be taxed. Now the IRS could take a different position. There's always the saving clause, but at the end of the day, that's probably not a frivolous position to take. Few other issues. Let's say it's a grantor trust instead of an employment trust. Then the rules change. With a employment trust, if the employee contributes or over contributes, then it could become a foreign grantor trust if the employee owns more of the trust than the employer does, because he or she has contributed more. In that type of situation, they would have to pay tax on the income attributed to the portion of the ownership of the grantor trust. HCEs, highly compensated employees, this can get pretty technical, but it generally comes into play when there is a retirement or pension plan, and let's say maybe it was non-discriminatory and then it became discriminatory, so it's discriminating in favor of highly compensated employees. In that type of situation, the highly compensated employees, not the non-HCEs, but just the HCEs, have to pay tax on the income attributed to the portion of the ownership in the trust, yada yada. Very complicated, not necessarily specific to foreign pensions per se. It can have some impact, but it's very specific scenarios. Form 3520 and 3520A for an employment trust, most practitioners don't report it on 3520 and 3520A. Some do, just to be on the safe side. There's nothing wrong with it, especially if the employee believes that they might reach the contribution limits or over the 50% versus the employer. That situation happens, for example, if the employee no longer works for the employer, but that pension is still there or that trust is still open, and the employer is contributing even after tax funds to it. Revenue Procedure 2020-17 came out around February or March of 2020. Basically says to reduce duplicative reporting, certain foreign retirement trusts and even non-retirement trusts, if they meet the requirements, which themselves are ambiguous, you may avoid filing 3520 and 3520A, although the 8938 and the FBAR would still be required. If you're out of compliance, this all sounds like nonsense to you, and you've just learned about it and you want some help with it, you may consider getting into voluntary disclosure. There's various different programs. The traditional voluntary disclosure program, which is for individuals who are out of compliance and cannot certify under penalty of perjury that they're non-willful. There's the streamlined filing compliance procedures, the domestic and the offshore program. which is for taxpayers who were non-willful. Each program has its own set of requirements, but non-willfulness is always a requirement. There's some alternatives to the streamline. There's the reasonable cause or the delinquency procedures if you qualify. Again, my name is Sean Golding with Golding & Golding. I hope the presentation was helpful. Thanks. Enjoy the rest of your day.